The last two you mentioned are leveraged silver suppliers. They're not hugely efficient. They're not low on the cost curve. They don't have great track records. I take that back. First Majestic has a pretty decent track record in terms of return on capital employed. Hecla and Coeur don't. But they have huge margin increases. So you need to think of Hecla and Coeur and First Majestic as leverage plays on silver. And by the way, they have some catching up to do. People, when they look at them, not much, to be honest with you. The people who were attracted to the gold story, who gave up in despair, are back buying in earnest. But that's a fairly small part of the population. The increase in gold demand has really come from foreign central banks. And that's occurred because the US government forced them to do it. We monetized the US dollar, and we set up a circumstance where structural inflation in the United States reduces the continuing purchasing power of the US dollar. The foreign central banks had no choice but to buy gold, and they still have no choice but to buy gold. Now, I need to say that had you interviewed me in 2026, I would have told you the price of gold has to go up. It has to go up. I don't know that I could say that anymore. I think it will go up, and we can talk about that later. But the coiled spring aspect of gold, when it was selling for $2,000 an ounce, and in particular the coiled spring aspect of silver, when it was selling for $20 an ounce, that's gone. The pressure on the spring has been relaxed. In terms of retail interest, yes, there are net inflows to retail ETFs around gold in both North America and Europe. But it would appear that the strongest new retail participation in the gold space is in India. Not in India, in China. It wouldn't surprise me to see increasing retail favor around gold because of an interesting circumstance, an interesting psychological circumstance, where most investors don't pay attention to the efficacy of a narrative until it's been justified by price. In other words, the move of gold from 2,000 to 4,200 justified the narrative, and people have the courage to buy at 4,200 what they didn't have the courage to buy at 2,000. This is an unfortunate tendency for most people. It's very fortunate for me that they have that tendency, but it's unfortunate for them. The idea that you require price action to validate a narrative when the narrative becomes less valuable itself as a consequence of the price action is interesting. I was on a Q&A yesterday. We were talking about silver. And I said to my questioner, you realize that the fact that the silver price has doubled makes it arithmetically precisely half as attractive. They liked the psychological relief of seeing the silver price go up, which justified the narrative. They forgot about the fact that the easiest part of the benefit has already been felt.
Investor psychology plays a powerful role in precious metals. Many people only believe a story after prices confirm it. Gold's dramatic rise validated the narrative, giving investors confidence to buy at much higher levels than they once feared. Ironically, that same price appreciation reduces future returns. Silver illustrates this perfectly. Once it doubled, its mathematical attractiveness was cut in half. Investors often feel relieved when prices rise, forgetting that the most accessible gains are already behind them. This emotional pattern benefits disciplined participants, but it repeatedly leaves latecomers paying a higher price for reassurance.
The circumstance, the political circumstance and the social circumstance is more dire now than it was then. I realize in my heart of hearts, I think, that the escalation of gold prices relative to some asset classes was extreme in 2011, but I didn't sell my gold because to me, gold is savings. I continued to buy it. Now, my savings got devalued. Okay, I get that. For me, physical gold is not an investment. It's not a speculation. It's insurance. It's savings. And my gold functionally isn't for sale. My silver is very different. I bought some physical silver as a consequence of my belief that the silver price had to double. And now that the silver price has doubled, I will likely sell it because to me, it isn't a savings asset class. It's an investment in speculative asset class. And I got lots of investments in speculations. To answer your question specifically, though, and I don't have the relative statistics for 2011, but the circumstance around the reasons that would make gold go up are much more dire. They include $38 trillion in on-balance sheet liabilities of the U.S. government. I don't know what the same number was in 2011, but it would be easy to Google. And believe me, it wasn't within striking range of $38 trillion. But a much more egregious problem is the net present value of entitlement obligations in the U.S. Medicare, Medicaid, Social Security, military pensions, federal government pensions, the Environmental Trust Fund. This is a scary number. According to the Congressional Budget Office, it's $120 trillion. See, add those two numbers together, 38 and 120, you get $158 trillion. Check this out. The IRS says the aggregate net worth, private net worth of American citizens is $167 trillion. So we own $167 trillion and we owe $158 trillion. Now, yeah, they could deal with that by, selling off the national parks, little stuff like that, all the federal government land. What do you figure the probability of that is? I reckon it's pretty low. But Vlad, it gets worse. Every year, the on-balance sheet liabilities of the U.S. government, the deficit, grows by $2 trillion. And the off-balance sheet liabilities of the U.S. government grow by between $2 and $3 trillion a year. Now, to put that in perspective, you add $2 trillion and $3 trillion, you get a number called $5 trillion. That's how much the deficit on and off balance sheet grows every year. It also happens to be the gross income of the U.S. government. Taxes, tariffs, which are taxes, fees, all that stuff. The gross income of the federal government is $5 trillion a year. And the increase in our deficit is $5 trillion a year. You get the problem.
For some investors, gold is not a trade but a form of savings and insurance. Its purpose is preservation, not profit-taking. Even when gold prices peak or pull back, it remains a hedge against systemic risk. Silver, by contrast, behaves differently. It is more volatile and more speculative. When silver meets its intended objective, such as doubling in price, a disciplined investor takes profits, regardless of future potential. This mindset avoids emotional attachment and fear of missing out. Long-term optimism does not eliminate the importance of acting when original assumptions are fulfilled.
I have no idea. I'm reminded of the wonderful Hemingway quote. Hemingway wrote a lot of books, sold a lot of books, enjoyed a lot of royalty income from his books, and he went broke. And an interviewer said, "How on earth did you go broke?" And he said, "Slowly at first, then all of a sudden." And I think this is appropriate. And by the way, I don't think the U.S. will go broke. I think what we will do is we'll inflate away the net present value of our obligations. That's what I think will happen. When it will happen, I don't know. What could go right? I mean, how did we get out of the 1970s? In the 1970s, by the end of the 1970s, there was a broad spread belief in the United States amongst all races, colors, creeds, ages, classes, that the current circumstance was unsustainable. And we gave Ronald Reagan a broad mandate to reduce government expenditure, which he didn't do. But he reduced the growth of government. And he backed Paul Volcker to give us an absolutely bitter pill. They raised the interest rate from 5.5% to 18%, which choked inflationary expectations and led to a massive flow of dollars in the United States from those countries that had been our creditors. The consequence of that was that as the interest rate began to come down, the economy grew fast enough that it was able to overcome the accumulated debt sin for a while. Rather than use the surplus to pay down the debt, however, we used it for a return to good times. In other words, we squandered a wonderful advantage, and we never cut the size of government, ever. We didn't do that. Now, it could be, Vlad, and I hope it is. I mean, make no mistake, we are going to inflate away the net present value of the deficit. I don't know if you know this or if your listeners know it, but in the decade of the 1970s, the purchasing power of the US dollar, according to the Office of Management and Budget, now called the Congressional Budget Office, the purchasing power of the US dollar over 10 years fell by 75%, meaning it took $4,000 to buy $1,000 worth of goods and services at the end of the decade. What that did is it reduced by 75% the real value of our obligations. And as the economy began to grow, in effect, we reduced the real value of our obligations by 75%, the purchasing power. That's what we're going to do again. And it's going to be really unpleasant for people on a fixed income. It's going to be really unpleasant for Americans who don't have the education or the skill sets to generate enough utility in their employment so that their wages can rise as fast as the purchasing power of their wages declines. There will be a material reset in the standard of living of Americans. A second problem I see in the United States is that you are seeing increasing popularity to the belief system that caused us to be problematic anyway. You have an overtly socialist mayor in New York City. One would say an overtly communist mayor in Seattle. A woman who, by the way, lived with her parents at 42 years of age while she was running for office. You have, Bernie, feel the burn in your wallet, and AOC advocating precisely the policies that are the cause of our dilemma today. And they're not unpopular. So there will be some challenges. We will overcome them. The good news is this, and there is some really, really, really good news. Young people are sick of old people's circumstances. The understanding of the younger people that old guys like me voted ourselves a bunch of benefits and forgot to pay for them is alive. And that's a very good thing. You need to understand the problem before you attack it. The second thing is that for all of our faults, the United States is still the most technologically competent and most innovative society on the planet, including the Chinese. If we get out of our own way, this is still a place where 5 or 6 kids can commandeer a garage in Sunnyvale, and out pops Google or Apple. And that's wonderful, because as technology allows us to increase our productivity with less capital investment, the fact that the government has already stolen most of the capital doesn't mean that we can't engineer our way out of some of the challenges of growth. So if we inflate away the net present value of our obligations, causes 75% of those obligations to go to money heaven through inflation, admittedly at an ugly cost to people's standard of living, and if we reduce the growth of government expenditure, and if technological innovation in the United States returns to past levels, we'll get through this in fine order. We'll have a 10-year reckoning or so, and it'll be truly ugly. Truly, truly, truly ugly. And the circumstance will exist 10 years from now or 12 years from now or something like that, where you have to sell some of your oil stocks and some of your gold stocks to buy recovery plays. But this is not the time.
The deeper case for gold rests on fiscal reality. U.S. on-balance sheet debt now exceeds $38 trillion, while unfunded entitlement obligations approach $120 trillion. Combined, these liabilities nearly match the total private net worth of American households. History suggests such burdens are not repaid honestly, but inflated away. The 1970s provide a warning. The dollar lost roughly 75% of its purchasing power in a single decade. Inflation reduced real debt, but devastated savers and fixed-income earners. A similar outcome today would reshape living standards and reinforce gold's role as protection.
I don't know. Make no mistake, I think the silver price is going to go up. Make no mistake. I think the gold price does well over the next 10 years, and I think the silver price goes better. But I don't care what I think, Vlad. I bought some silver in the expectation that it would double. It doubled. A disciplined investor, when the circumstance that has occurred that caused him to take the action occurs, you take the money. So, despite the fact that I think over 10 years the silver price rises substantially from here, the fact that silver has doubled in a year and met all of the expectations I had for that speculation, I haven't, by the way, I haven't taken the money yet, but I'm gonna. Um, I have no fear of missing out, Vlad. Let's say that I sold some $25 silver and some $40 silver. Let's say I sold that for $80. Uh, I made 40, $50 an ounce. And let's say that the silver price goes from 80 to 110. So I missed $30 an ounce. Is taking a $40 an ounce profit in a year the worst sin I'm ever going to commit? I don't reckon. I hope whoever buys that silver from me makes a boatload of money, because I'll make 3 boatloads of money on my silver stocks. I'm okay with that. But I bought that silver for a reason, and the reasons come true. The last two you mentioned are leveraged silver suppliers. They're not hugely efficient. They're not low on the cost curve. They don't have great track records. I take that back. First Majestic has a pretty decent track record in terms of return on capital employed. Hecla and Coeur don't. But they have huge margin increases. So you need to think of Hecla and Coeur and First Majestic as leverage plays on silver. And by the way, they have some catching up to do. People, when they look at the free cash flows in Hecla and Coeur and First Majestic, are using a $40 price curve. They're not using an $80 price curve. And there's going to be spectacular earning surprises for the next 2 quarters. In Pan American, you're talking about something different. You're talking about a low-cost producer, admittedly, 55% gold revenues, 45% silver revenues, not leveraged to silver as much as it was. But the zeitgeist, the shareholder base, is still very, very silver-centric. And with the takeover of MAG and Juanicipio, they're the owners of one of the highest quality silver properties in the world. They also have a mine in Mexico, the name of which escapes me, that has a very, very, very large primary silver deposit underneath the existing workings. That's a deposit where the upfront capital cost to build it probably didn't work at $40. Works great at 80. Beyond that, they have 1 billion ounces in high grade silver in 2 deposits, one in Argentina, one in Guatemala, that for political purposes, they couldn't return to production or put into production. I suspect that the social rents, the taxes and royalties on those 2 projects at $80 silver will compel the governments of Guatemala and Argentina, out of their own greed and larceny, to allow those projects to go forward. 1 billion ounces of high-grade silver, which does not figure yet in the balance sheet or the income statement of Pan American. I'm not saying it's going to occur, but think of it as a 1 billion ounce option that you get for free.
Economic stress is fueling political movements that favor expanded government spending, even as the costs become clearer. This creates long-term challenges, yet there is optimism. Younger generations increasingly recognize the mistakes of unfunded promises and unsustainable policies. More importantly, the United States remains a global leader in innovation. Productivity gains driven by technology can partially offset capital destruction caused by excessive government expansion. If inflation reduces real debt, government growth slows, and innovation accelerates, the economy can eventually stabilize after a painful adjustment period that rewards resilience over speculation.
There's a piece of black magic that goes on in financial markets. You take gold and silver, byproduct cash flows, you take it out of a copper miner. Because at a copper miner, that cash flow gets valued in the market at 5, 6, 7 times cash flow. You segregate it from the copper story, And you segregate it from an operating mining company into a financial instrument, a stream, and that cash flow all of a sudden sells at 15 to 17 times cash flow. This is wonderful. People don't understand that kind of alchemy. And it's important because, first of all, the gold and silver cash flows are higher now as a consequence of metal prices. But this coincides magically with the time when the copper industry has to spend 150 or 200 billion dollars building new copper mines, and they don't have the money. People look at the royalty and streaming companies and they say their growth periods have passed. The big transactions are behind them. That's exactly wrong. The big transactions are ahead. The royalty and streaming companies probably provide $30 billion of the capital, most of the equity, by the way, $30 billion of the capital required in the copper business in the next 10 years. And these streams have another financial use, takeovers. One company takes over another company, and they're looking for the equity to support the debt to do the takeover. You sell a stream. Because the cash flow is so much more highly valued in a stream as it is in an operating company, the streaming component of the capital stack can be disproportionately large with no dilution to the streamer. And then the third thing, resource nationalism around the world. Countries around the world want to own 20 or 25% stakes in large mines on their territory. By international law, although they violate that sometimes, you can't steal them. You have to buy them. And the problem is that the countries that want these stakes, Indonesia, Congo, places like that, don't have any money. Selling a stream on the underlying asset and then giving a bond to the mining company so that the equity stake is made out from the free cash flow of the mine solves this problem neatly. So I think the high quality streaming companies, which currently are suffering a little bit from the market's expectation they have no way to grow, will do very well when these three growth strategies become apparent to the market.
Silver equities, streaming companies, and royalty models offer leveraged exposure to rising metal prices. Many producers are still valued using outdated assumptions, setting the stage for earnings surprises. Streaming and royalty firms in particular transform commodity cash flows into high multiple financial assets. This structure becomes critical as the global mining industry faces massive capital needs, especially in copper. Additionally, resource nationalism is pushing governments to demand ownership stakes in mines, often financed through streams. These dynamics suggest that high-quality streaming companies may be entering a new growth phase, not the end of one.